What is up, everybody? Tyler here with Vant Trading. As I promised, I will be diving into more in-depth Fibonacci retracement levels and how I use them to trade and how I pull money in the markets using the Fibonacci's. So first, I want to mention that they do work best when the market's trending. It's tough to use them. You really can't use them in consolidated markets unless you use a 50% level, but that's another story for another time. The theory is, after price begins a new trend direction, the price will retrace back to a previous level before resuming in the direction of the trend. Now, finding Fib levels, you have to be able to identify swing highs and swing lows. So basically, if I zoom up real quick, this is a downtrend. This is a swing high. This is a swing low. This is swing highs. So you have to be able to identify market structure and what swing highs and swing lows are. And then if you know how to do that, you can use fibs. It'll take a little bit of time to master, but once you master them, they're very profitable to use. Now for a downtrend, you want to draw fibs by starting at the swing high and then drawing and then taking down the swing low. So you take your fibs and you start. Here's a swing high, right? So I'm going to start the swing high and trail it down to the swing low, and then you extend it, and that's where you're looking for retracements to continue the downtrend. And it's pretty similar to, it's the same for when you're looking at trends up. You're drawing from your swing lows, and you're drawing all the way up to your swing highs and looking for a retracement that way. So that's how you draw the fibs. Now let me show you what levels I use and how to use these levels accordingly. So first off, we have the 23.6%, and that's basically just the consolidation level. I don't really use it. I mean, I just keep it on there to know that if we're on a trend and we're pulling back a little bit to the 23.6, we're going to consolidate in between this level. This is the consolidation zone right here. I don't trade this zone, but when it starts breaking down to the 23.6, I'm sorry, the 38.2. This is a level that I use. It's called the strong trend retracement, and that's just something I call it. Now, when you're on a strong uptrend like this, you're on a strong uptrend. You're looking, if you're trying to find an entry on this move, you're looking to enter on this pullback here to look for a continuation up. And that pullback, what you're going to want to do, you're going to want to take your Fibonacci's, draw from your swing low up to your swing high, and notice that this pullback is going to be at the 38.2 level. That's where you're going to want to enter. Now, you're not going to want to enter blindly. You want to find some kind of candlestick formation pattern to give you confirmation, or whatever you use. You want to find some way of finding confirmation that it is going to respect this zone here, and it's a good area to enter as you go up. Right, so the 38.2 is the strong retracement level that I use. Now looking at the 50% level right here, this is not really, it's not an official fib level. It's more of a psychological level for traders. So I'll use it sometimes, like when you're in a trend here. Sometimes it will actually pull back past the 38.2 and back down the 50% level. Now, I'll still consider that valid because some traders prefer that as like a psychological level. And keep in mind that these are just areas of interest. They're not precise levels. So as long as I'm around the 38.2, this area right here, and it respects this area, I'm considering that a strong trend, and I'll look for an entry. So the 50% is not an official level. It is just a psychological level for traders. Now, the 61.8 retracement, that's what I use for reversals. Now, when you're looking at market structure and it's on an uptrend, right, and you're seeing that's creating higher highs and higher lows, after you see this pullback, it creates this lower high, breaks this low, and now what you're looking at is, it broke market structure, right, because it broke and made a new low. And now what you're going to look for is a 61.8% retracement, then only to give you that continuation reversal. Now what I mean is, take your fibs, and draw it. So this is where the right here, let me get the arrow out. This is the point of where it broke structure, right? Because it ended up breaking this previous low right here. And that's where, so where you want to draw your fibs is the start of this move of where it broke structure. So in this case, this is not candles, but if this were a candle, I would draw it from here. That's the wrong thing. I would draw it from here to start down to this area, and I'm looking for that 61.8% retracement. And once I find a confirmation that is respecting that level, I'm taking a sell, looking for that trend reversal, or buys if it's a reversal that way. But that's how you trade. That's how I trade the 61.8%. Because if you're in a trend, right? If you're in a strong trend, you don't want to see a very deep pullback, because that means that the buyers are getting exhausted and some sellers are taking it and kind of getting in there a little bit, breaking up that uptrend. So it's going to be a little bit weaker of a move then. Then you might start to see a little bit of reversal there, right? So that's why I only use the 61.8% retracement as a reversal zone, and I don't use it as a continuation zone. And the 78.6 I'll use as like a hard backup stop. Now when I'm trading, and if I get this uptrend, right, and I get this pullback to 38.2, and I get this this candle right here, and then it continues up, I'm placing my stop at that low of that move, because in theory it should really respect that low if it's created its new swing high. If it's created its new swing low here, a higher low, it should respect that low that is created and continue up. So if I'm taking an entry here at 30.2, I'll usually have like maybe the 50% level as my stop, maybe just above. But that's what I 78.6 again. I just have as like a backup stop there. Whoops, and then I don't really use these. Well, I'm sorry, the 88.6 and the 127.20. They're just on there. Actually, I could take them off. But so if you want to look at my style, these are this is what I have. Let me just take them off right now because I don't even use them. This is what I have. So if you want to screenshot that or take a look at it, that's what I use. And then obviously the 100% and the 0% is where your swing high and swing low are for the Fibonacci's. Then if you take a look at the negative 27% and the negative 100%, my first take profit will be at the negative 27%, and then my second take profit will be at the 100%. Now when I'm doing continuation trends, and it's an obvious uptrend, you're going, and you get this pullback to 38.2, I'll have my take profit, and I'll usually take my full take profit off at negative 27%, because it's already obviously a strong trend, but I don't want to get caught in that reversal scenario to where it breaks this high, gives us that negative 20%, but it doesn't give us enough of a move to get to the 100%. Instead, it starts creating that reversal and go. I don't want to get stuck in that, so I prefer to take my 2-3 to 1 risk reward win and take profit at negative 27%, because I'm not going to get greedy there. But now when I'm trading trend reversals, that's when I use the negative 100%, because if you have this downtrend here, excuse my drawing, but if you have this downtrend, then it creates this break of structure here, breaks this high right here, and then it's going to retrace the negative, or I'm sorry, not the negative, the 61.8% retracement, this level right here. Then in theory, since it's a reversal, it should have a stronger move because it's only the beginning of the trend. So now I'm looking for a big move up to the negative 100% instead of that negative 27% retracement. So you'll get a larger move on those reversals if you can spot the right times to get in, which is why you need an extra set of confirmation. And I use candlestick formation patterns, and I'll show you what I use. But this is in a nutshell how I use my fib levels. And when you're using fib levels, make sure you keep an eye on recent support and resistance. Usually it'll kind of coincide with the fib levels, but it's important to know where your price action is and where your levels are, because again, guys, there's no strategy that's foolproof. Fibs will fail you every now and then, but you just got to know that you can cut down those failures by looking at price action and where your important levels are. So let me give you a couple examples now of how I actually use them. And we'll start, since we're already here, we'll start right here, right? So you have this obvious downtrend, right? It's moving down, creating its swing highs and swing lows, right? Boom, boom. Then you have this swing high here, and if you notice, it breaks this swing high right here, and that's a valid swing high because you have this swing low right here that broke this previous low. So this is a break of structure, and now what you're looking for is you're looking for that reversal. And I'm going to take my fibs and start where that original move was, draw them up to the where that so you have the swing low here, the new swing high. Now you're looking for that 61.8% retracement. So if you zoom in and you take a look a little closer, this move right here is where it's rejecting the 61.8% retracement, which is this zone right here. Actually, let me make that a little clearer for you. That pink box right there is that 61.8% retracement, and this move right here is the retest. Now what I'm expecting from here is for a continuation up, and I'm looking for that negative 100% retracement or continuation for a take profit. Now once it hit this zone, you got to look for some kind of extra confirmation. Now in my case, I use candlestick formation patterns, and this right here is an obvious bullish engulfing candle. This bullish candle is engulfing the previous candle. That's a good sign that we're getting a rejection at this area, and I can take my entry. Now this is where I take my entry. I place my stop below the low, which in this case is about 27 pips, and my take profit is going to be at the negative 100% retracement, and then I just kind of let it do its thing. And what does it do? It goes up, busts through my negative 100% retracement right here, and then completely fails and reverses back to where my entry was. That's why I use the negative 100% retracement, because I caught 2 times more than what I could have caught if I just gotten out of the negative 27. Because on trend reversals, you typically get a larger move, so that this is where I take my full position out at. In this scenario, it was a 6.3 to 1 risk reward. Very good trade. That's how I analyze the reversals. Now let me give you another example on how I analyze trend continuations. So let's see, this right here is moving up an obvious uptrend, right? And if you take a look, you have your swing high, swing low, obvious uptrend, swing high, swing low, swing high, swing low. And now what I'm looking at is I'm looking for a way to enter the market. And if I see this big swing high, this is due for a retracement because it's a very large move. I'll draw my fibs from here up to the top. And what does it do? Let me remove these lines so you can see it better. It completely rejects and closes at this 38.2% retracement, which is what I call the strong trend retracement. And now once it hits this level, I'm not blindly buying, but I'm going to wait for some kind of bullish price action to give me confirmation that, okay, we're going up now. And it gives me this, again, bullish engulfing candle. So with that bullish engulfing candle against that 38.2% retracement, I think we're good to go for a continuation entry. So I take that long right there. Whoop, apologize. I put my stop below the candle's low, and then take profit is the negative 27%. And that's obviously I missed out on a ton of the move because I could have caught in this twice as much. But on these plays, what you could do is, and this is sometimes what I do, is I'll take half off at negative 27%. In the case that if I am stuck in this trend reversal, I'm at least securing some before before it reverses. So I'd take half off at negative 27%, and as you can see, it rejected that level hard. And then at that point, I'll trail my stop to break even, and then I'll leave the rest to run to negative 100%. which ends up rejecting it perfectly, sitting along that. And if you look right, you know, you miss a little bit, but you're not going to catch the whole move, and it ended up rejecting it. So that's why I use those two levels as take profits, because they seem to be respected really well, and they tend to actually coincide with strong levels of support and or resistance. Because if you look left, this level of resistance right here, it's strong strong level of rejection, and if you look, that's negative 27%. If you look left here, this strong level of rejection right here happens to be the negative 100%. So they end up, you know, I like them because they actually are strong levels of resistance as well. So they're good take profit zones. That is how I use fibs in my trading, and how I find quick swing plays, quick day trades, depending on what time frame you're using. It works both ways, swing and day trade, just depends on what time frame you use. I use them off the 15 and 30 minute, so they're typically day trades, but they're more confirmed day trades, because you don't get whipped around like smaller time frames. So, you know, these work in stocks, they work in Forex, commodities. Fibs work the same all over any market. So what I'm giving you right now, just pretend like this is a stock you're trading. You use it the same exact way for reversals, continuations. You draw your fibs and you let it do its thing. Now there are plenty of other scenarios. Like I can pull up the Dow Jones real quick and give you like a little quick example. Here we'll try to catch this reversal here. So what I'm looking at here is you have this obvious, you know, swing high, swing low, swing high, swing low. And, you know, once you see that it's really having trouble in here and it's not breaking out, well, you see this is the break of structure right here. So if you break this high right here, you're going to have most likely a trend reversal, and that's where you're going to draw your fibs. And now what you see right here is you have that breakthrough, and it created a new high, and now we're in a trend reversal mode. So I'll take my fibs, I'll start it at that breakthrough candle. I'm not starting it down here or down here. I'm starting it at, you know, where it broke market structure, and that was right here, where the clean move was made. And the clean move was made from this candle right here, this low, to this high. Now, what I'm looking for now is a rejection of the 61.8. But what this, I don't consider wicks as, you know, they are rejections, but I don't trade off of the wicks, because I like to find that I get a lot better entries if I wait for a close at this level. Because if I entered here, well, first off, there's no entry there. I mean, I'd have to go to like a 5 minute to find some kind of entry there. But first off, on trend reversals, I don't hop down lower time frames. On trend reversals, I only stay on the same time frame I draw my fibs. So this was not a valid entry. This ended up coming down to the 61.8%. And what does it give us? It gives us that bullish engulfing. So I take my entry after that bullish engulfing, put my stop below the lows, and my take profit at the negative 100%, that's where I put it for trend reversals, and it was a 4.3 to 1 winner. I mean, that was a beautiful winner. And this is the Dow Jones. It's an index for the stock market, so this should show you that it's valid on indexes as well. And I'll give you another confirmation or another example on the Dow Jones, for a trend continuation. Let's just look at the same example, the same trend that we just saw right here, right? So now you see you have these, you have now this uptrend, right? I'm looking for a way to enter the market. So what I'm doing is I'm looking for, a 38.2% retracement, because that is my strong trend retracement. So after it makes this new high right here and pulls back to create this low, I'm now going to draw my fibs to see if I can catch this 38.2% retracement. And that's exactly where it goes. it's closing above this 38.2. Now it's okay if it wicks below, as you know, as long as it, you know, it did touch the 50%, which, like I said, as long as it's above the 50%, I'm okay with. If it wicks down here but closes above the 38.2, that's what I look at. So in this case, it closed above the 38.2, and on trend continuations, you can either stay on the current time frame, but what I usually like to do is I usually like to hop down on the 5-minute, and in order to find a more precise entry. And now my entry, you know, this was the area we were looking at. So let me hop down on the 5-minute. Geez. All right, where we at? Where we at? Bear with me a second here. We're right here. All right. So the 5-minute. Let me just draw them real quick again. This. Yeah, this is where we were, I believe. And if you take a look, you have this set right here of tweezer bottom. It's called a tweezer bottom. If you look up a tweezer bottom, that's something that I use often as well. That's a bullish candlestick formation pattern. And then after that tweezer pattern and this double bottom on the 50 and 38.2, that's where I take my entry, and I take it as it breaks the high of that tweezer candlestick. Put my stop at the low. I take profit the negative 27% for my first half, then my second half the negative 100. And then after I take 50% off the first half right here, which was right there, I then am setting my stop to break even, or letting the rest run. And in this case, it ended up going up and wicking, you know, not really wicking, but getting me out before it reversed back past my entry. So that's what that's how I trade the trend continuations. Now, if you go back to the 30-minute here, this is the move I just caught. And if you take a look, what I also like to use as confirmations is the 20 EMA and the 50 EMA. And when you're on trend continuations, usually I like to see the 38.2% retracement respect that 20 EMA, because strong trend continuations will usually ride that EMA, and you'll get a nice intersection trade right there as another confirmation. Now on reversals, and this is a reversal I just did right here earlier, I like to see that are the moving averages crossed over bullish, or, you know, in this case bullish, as another confirmation that, okay, we could be reversing. Yes, right here they cross over bullish, so they are cross bullish. And now on that 61.8% retracement, you know, I like to also see that respect the 50 EMA, because it's going to have a deeper retracement, so it's going to blow past the 20 EMA, but typically it will respect the 50 EMA, and that's exactly what it did. Gave me another confirmation. So I have like 3 different confirmations: bullish candlestick pattern, the Fibonacci retracement, and the EMA respecting the EMA. And that's how I take my Fibonacci trades, and that's, you know, that gives right there gives you a high win percentage if you have a lot of confirmations in there and know how to trade it right. I hope you found this video informative and helpful. You know, if you need any help at all with what I just went over, you know, any more help, please feel free to reach out to us. I'd love to help out. And you know, safe trading, and have a good day.